Hello everyone. Welcome to hBits' Smart Investor in 2022 session. We're excited to run through this session, and also thank you for all the attendees who are attending. Overwhelming response to the number of people that are attending, even though we don't have an asset right now. So it's great to see that there's such a keen interest in investments. I'd like to welcome Mr. Sameer Bhandari firstly, who's joined our team as CFO. Sameer comes with a wealth of experience. He has 30 plus years of experience in banking, working at companies like Bank of America, UBS, JP Morgan, and most recently, last 13 years at Nomura, where he was heading global market sales Asia. So Sameer comes with a wealth of knowledge, expertise about global markets, about investments, both globally as well as in India. Another part of Sameer is that he's also has an amazing educational background, although that was 30 years ago. He's a chartered accountant, as well as an IIM Ahmedabad grad. So to start off this session, wanted Sameer to take us through the various asset classes in today's day and age in 2022 that an investor has as an option, and also generally what's the overall global outlook for the economy.
Thank you, Shiv. Thank you for the very kind introduction. I guess the topic is very apt, the making of a smart investor 2022. I think it's so important for investors today to understand basically what are the risks they face, which are the asset classes they can invest in with a high return, low kind of risk environment, and obviously take into account all the risks before they make that decision. Because any kind of decision you make obviously can have repercussions, long-term implications. Given the fact that the markets have been so volatile, I guess it becomes more and more important to take decisions where you actually study the kind of implications. I guess the most important thing today is inflation. This is the big elephant in the room. One of the things I wanted to address is, why is inflation actually so high? Why are central banks so worried about inflation? Why is inflation today become the number one enemy for all the central banks? I guess it boils down to the fact that in the pandemic, the stimulus packages by all the central banks were very, very large. Just to give you a bit of perspective, from the US, there was a 5 trillion stimulus package, both on the monetary and the fiscal side, which is by far huge. I mean, if you compare this package to the packages, even in the financial crisis, it's multiples of that. Secondly, I think the conflict between Russia and Ukraine did not help. Oil prices, as you know, had gone to almost as high as $120, and now they are below 100. But the conflict continues, and I think the pressure on oil is also putting a lot of pressure on inflation across. I mean, it's across US, it's across India, it's across European countries. In addition to that, I think commodity prices continue to remain high. Food prices continue to remain high. We know that Ukraine is trying to find a solution where they can actually export wheat. But again, it's becoming a problem. So that's also caused inflation to remain high. Thirdly, I think supply chain. I mean, the whole pandemic situation, obviously a lot of the supply which was coming out of China actually got hampered, and supply chain has been a big issue. So now, though the pandemic is over in a way, demand is coming back, but supply is still very, very much constrained. And again, the Russia-Ukraine war adding to the woes around that. And so that's also putting a lot of pressure on prices. So what are central banks really doing about it? As I mentioned, inflation remains the number one enemy, especially for the Fed. It's a big, big concern globally. You talk to any central banker, they would say this is one thing we need to really fight, because obviously the savings of the people are getting eroded. And that becomes a big problem. And it's not only a problem around the economy, it's also unrest, civil unrest, which gets created because of inflation. And that's why the Fed is very, very particular about controlling inflation. In fact, as you all know, the Fed has raised interest rates by 75 basis points for the second consecutive time, following a 75 basis point hike last month. So we've seen the Fed fund rate, which was between 0 and 0.25%, today at 2.25 to 2.5. And what the economists are saying, that in September we have a meeting and we have another meeting this year. So you might have another increase of anything between 100 to 125 basis points. So that's obviously a big concern, where people are saying that could increase of interest rates actually push the US into a recession. I guess when central banks look at it, for them, the key thing is inflation. In US, the CPI data showed that inflation had risen to 9.1%. The Fed's target, just to give you again perspective, is between 2 and 3%. Now, can the Fed even dare to achieve that? If they were to, actually interest rates would have to go between 5 and 6%. And that obviously will push the economy into recession. So I think it's a very fine balancing act for central banks of pushing rates higher and making sure that the economy does not go into recession. A lot of economists are talking about that, given that the last 2 quarters, the GDP actually has contracted in the US is actually in a technical recession, because that's really the definition of a recession. And that's why I think the Fed is under a lot of pressure, making sure that they balance how aggressively they increase US rates without triggering a US recession. And pretty much the same is happening in India. I mean, the repo rate is at 4.9%. Tomorrow, I think there's a meeting. They're talking about increasing rates by anything between 35 basis points and 50 basis points. I think the central bank has been very prudent around how to increase rates. Obviously, there have been a lot of inflationary pressures in India, especially because of oil prices, and especially also because of food prices. But I do think the central bank has actually done a very, very good job in controlling overall inflation in whatever way they could actually do. So wherever they could increase interest rates, they have done that, and kudos to the central bank around it. So given the scenario, what do I see the different asset classes doing? And for that, let me go through each of the asset classes. I look at assets, I divide asset classes into 5 different assets. Basically, one is equities. Secondly is fixed income or akin to bonds. Third is FX as an asset class. A lot of hedge funds play that asset class. 4 is crypto, which has become a good asset class over the last 3 or 4 years. And fifthly, real estate. So let me go through each of these asset classes. Let's talk around equities. Equities has had a very, very tough first half. I mean, till June, if I look at the US markets, equity markets were down close to 25%. The S&P was down 21, 22%. The tech index was down close to 30%. Obviously, a lot of people who have assets in equities got hit very badly. India, obviously, a lot of people have now savings in equities, and that's hit them quite badly too. Secondly, let's talk about bonds. This is the first time that bonds and equities have pretty much behaved the same way. I was looking at a balanced portfolio in the US where 60% was equities and 40% was bonds. YTD, and I was saying till end of June, that portfolio is down 19%, not very far from where equities were down. So it basically shows that all correlation between fixed income and equities had actually broken down, and everything was actually going pretty much the same way. So bonds were doing pretty much the same as what equities was doing, which is normally historically not the rate. Bonds, the volatility is a lot lower than equities, but this is the first time where both the asset classes were down dramatically. If you look at FX as an asset class, the dollar continued to strengthen. Dollar was up against pretty much all the currencies. Against the euro, it was up 15%. Against the sterling, it was up 10 to 12%. Against the rupee, dollar went up almost 7%. Though historically, I would say rupee has depreciated roughly 4.5% per annum over a long period of time. So if you were to take a period of 5 years, rupee would typically depreciate around 20-22%. But here, because of the dollar strength, we saw rupee depreciating almost 7.5%, and touch 80 briefly, but it has come off. The cryptos got hit the most. I mean, Bitcoin hit a high of 68,000 and went to as low as 17,000, presently trading around 23,000. A lot of millennials who had invested in crypto actually lost out quite a lot. And there were some of the cryptocurrencies which actually went pretty much to zero. So obviously, this was an asset class which initially was touted as, when it's very uncorrelated to the equity markets. When the equity markets are doing badly, crypto would actually be doing well. But obviously, that was not the case. And crypto got hit probably the worst in the first 6 months. Talking about real estate, I think real estate as an asset class has actually done reasonably well. I mean, if you compare globally, only very, very recently the residential market has started getting hit in the US and some of the other places. But I would say overall, real estate has been extremely resilient, especially on the commercial side. So globally, real estate as an asset class has done much, much better. Maybe in 6 months' time, it could be different, especially because the residential market is getting hit, but commercial continues to do reasonably well compared to the other asset classes. So going forward, what do I think? Equities, I'm reasonably optimistic around where equities are going to be in the next 6 months. I think the first 6 months, it's been a lot of fear. And I do feel when there is fear, greed is actually good. And when there is greed, we should be fearful of the markets. So I do think the markets had become very, very pessimistic by end of June, and hence July saw a massive rally both in India and globally. And I think that continues for a while. Though there are a lot of people who are still very fearful. If you talk to a lot of economists, I think the JP Morgan economist is bullish, but Morgan Stanley, Goldman research analysts are not so bullish. But I personally, if you think, am bullish. I think people have been very, very fearful. And this is a lot of short covering which is happening in the markets, which might continue for a while. So if I were to predict the next 6 months, I would not be surprised if both India and global indices are up between 7 and 10%. Similarly, I think the data which is coming out of the US, I think inflation will slow down. I mean, we have seen commodity prices coming down. We've seen oil prices coming off. We've seen food prices coming off a lot. So I do think inflation definitely will come down slowly, and which will again be bullish for equity markets. I think job scene continues to be very good in the US. The jobs data which is coming out still shows unemployment pretty much at its low. Jobless claims are though going up, but the job market continues to be very, very robust. So overall, I do think the worst is really over for global markets, and we should definitely see an improvement for the next 6 months as compared to the first 6 months. So thank you. I'd like to stop there and let me pass it on to Shiv to talk about the real estate market in India and globally.
No, thanks, Samir, for that. I think very informative and very enriching. You gave a a great overview of the global macro view and how that's playing into the various asset classes that you mentioned. So thanks for that. I'll take off where you left on the real estate side of things, where you said you touched upon it a little bit, where we are seeing a good uptick in commercial real estate, and I'll concentrate a little bit more on India specific, because majority of our attendees are based in India or have interest in India. So commercial real estate obviously went through a little bit of a tough time during the pandemic, and even if the raw numbers state that, right, your half yearly absorption in 2020, your first half of 2020, 12 million square feet were absorbed. 2021, 9 million square feet were absorbed, which was much lower than your 2019 numbers. But what we've seen now is a major bounce back. So 2022 absorption is 20 million square feet, which matches that level of 2019. And 2019 being one of the best years in Indian commercial real estate. So it's safe to say in a way that commercial real estate is back, and it's back very, very strongly. In fact, and even the amount of foreign or institutional investment coming into commercial real estate has been very, very healthy. So again, first half of 2022, about $2.5 billion have flown into institutional investment has flown into real estate in India. So obviously these numbers give a higher level perspective, but even at a ground level, being in the market, talking to people. In fact, just a few weeks ago, I was talking to someone who works at JLL, and he mentioned that he had no time to breathe, because he had so many meetings with various different lessees who are now coming back to office and they want to take up new space. So yeah, commercial real estate in India is back, and back very, very strongly. To talk about the dynamics of commercial real estate in India and what really drives demand and what really drives supply, there are three things that I want to touch on. One is what creates supply in commercial real estate. Other is how, and Samir, you mentioned this a little bit, but how depreciation, forex, or depreciation of the rupee plays into commercial real estate. And thirdly, what is the impact of inflation on commercial real estate? Because as you mentioned as well, inflation is a major problem that the US is dealing with, India is dealing with. So what is the impact of inflation on commercial real estate? So these are the three things that I want to touch on right now. So going through all three of these one by one. So from a supply standpoint, the beauty of commercial real estate versus say a residential real estate. And I think most people are obviously more familiar with residential real estate. And residential real estate, there have been periods where there's been a huge oversupply of residential real estate, prices stagnate, and India has seen that in the last several years. So that's a little bit more unlikely in commercial real estate owing to the nature of the business. So what do I mean by that? In residential real estate, effectively, it's pretty easy for anyone to become a developer, because your requirement of capital is very low, because you can start a project and you can take money from customers and put that into building your project, and post that, give it to the customers on completion. So you get money upfront from your customers, and then you can build the project, which is why there are a far number of residential developers, because you don't need as strong a balance sheet, or you don't need as much financing on the residential real estate side. How does this differ in commercial real estate? So in commercial real estate, your end customer is a tenant. Your tenant could be a Deloitte, it could be an Accenture, it could be a JP Morgan. So all these players obviously are renting the space. They're not owning the space. And they're not going to give you any money up front. They're going to wait for the building to be completed, and then they'll take the building on rental. What that means is that for a developer of commercial real estate, you need to be much more strongly capitalized. You need to have a much stronger balance sheet to be able to put up the building. So one, that leads to inherently much harder to create new supply in commercial real estate, which favors investment in commercial real estate. And what that means also is that owing to this nature, the cycles in they're not as strong cycles in commercial real estate. It's much more a stable income and a much more safer investment than say investing in under construction residential real estate. So that's one aspect about commercial real estate. The other is where does the rupee depreciation come into play? Like we've seen, rupee is almost touched 80. It appreciated a little bit in the last few days, but there's been strong depreciation pressures. In fact, RBI had to spend about 10% of the forex reserves to protect the rupee. And while rupee depreciation obviously has varying impacts on the Indian economy, and a lot of times people are negative about the rupee depreciating, and I'm not going to talk about the overall picture about how rupee depreciates impacts the economy, but talking specifically about commercial real estate, it's in fact beneficial. And it's beneficial because over 60% of Indian companies, over 60% of consumption of commercial real estate in India is driven by companies that are headquartered in US or Canada. And then even a larger fraction that are foreign companies. About 80% are foreign headquartered companies that are consuming commercial real estate in India. And most of the decision making happens in their headquarters to consume commercial real estate. And they think on a dollar per square feet metric. So as the rupee depreciates, for foreign consumers of Indian commercial real estate, it becomes cheaper for them to consume commercial real estate in India. So this is why rupee depreciation, in a certain sense, is favorable for commercial real estate. While this is obviously different for Indian entities, because such a large portion of real estate is consumed by foreign investors, it makes it by foreign entities, it makes it more lucrative. The third part is obviously the inflation. Inflation is something that's on the tip of everyone's tongue right now because it's so prevalent, which is why a lot of asset classes are now volatile, which is why equities and bonds have both fallen, Sameer, as you mentioned. And this is where commercial real estate has traditionally been a very, very strong inflation hedge. Because as inflation rises, your cost of construction rises, the ability to have new assets is more expensive, and your rental rates go up. So as long as your rental yields are above your inflation rate and above your FD rates and above your repo rates, it makes it a very strong inflation hedge to protect your capital from losing value. So those are kind of...
Sorry, Shiv, can I ask you a question here?
Sure, absolutely.
I have a concern, right? I mean, there's been work from office earlier, work from home, now work from office. If you look at a lot of the US cities, still the hybrid culture continues. Some they come and work a couple of days in office. Firstly, how does that impact the India CRE market? So that's one thing I'd like to know.
Right.
Also, given the fact that we are into fractional real estate and selling fractional ownership, how do you compare it to a public REIT, right?
Sure.
So if you could just explain these two things.
No, yeah, sure. I think those are both very, very relevant questions, both of them for any potential investor into commercial real estate. So to talk for the work from office versus work from home side, there are a few things that we've seen. One is, again, starting with the data. Like I mentioned at the start, the absorption of commercial real estate is there. It's at 2019 levels. So proof is in the pudding that commercial real estate is back. Now, one might ask, what are the reasons for the same, right? And what we're seeing even globally is companies like Goldman Sachs, Citigroup, Bank of America, Abbott, Comcast. I mean, the list goes on. All of these companies have called their employees back to office, and these are US based entities as well. And again, generally what happens in India is because India commercial real estate is driven by global forces, global headquarters. Generally what happens in the US, India follows suit in terms of the policy. So we are seeing the same in terms of traction, in terms of leasing traction. People do want to return to office. In fact, there were a few surveys that Colliers ran, which said that only 7% of occupiers prefer a complete work from home model. Yes, there will be a hybrid. There will be some back to office. There will be flexi, but for all of that, you require commercial real estate assets. And only 7% said back to office. In fact, about 75 to 100% of employees of mid-sized firms are already back to office as of March 2022. So we're already seeing a complete return to in-person. Sameer, you mentioned that a lot of corporates, maybe smaller corporates, maybe tech-driven companies in the US have this hybrid model, this work from home model that has picked up. What we see and what we're seeing, speaking to people in the market, whether it's occupiers of commercial real estate, whether it's speaking to people at JLL, Colliers, your IPCs, what we're seeing, which is very different to what's in the US market, is one is the ability to work from home, in the sense that people have much larger apartments there. They have much easier access to internet and connectivity. Again, if you look at the larger, in terms of volume, if you look at the largest segment of people who are consuming commercial real estate in India, it's your ITOs, BPOs, KPOs, your service-oriented industry, and a lot of the people who are majorly employed in these companies really do not have the ability or the comfort, or in fact even the want to work from home, because people live in small places, they live in joint families, and therefore coming to office is in fact a respite for them, because it gives them a new environment, it gives them a new space, which is why these are the reasons why we're already seeing most people are moving back to office, and this trend is obviously expected to continue. The other thing that you mentioned in terms of fractional ownerships versus REITs, right? Because now REITs has also become a major asset class in India. We have 3 listed REITs. Total market cap is about 65,000 crore of these 3 REITs. And yes, underlying asset is the same. Whether you're investing through fractional ownership or you're investing in through REITs, you're investing in commercial real estate. It's the underlying assets is the same. It's an office park or a warehouse that's rent generating, that's rented to a grade A tenants. But there are nuances. So to touch upon a few of the nuances, from a very layman's perspective, a REIT is like a mutual fund because there's a basket of assets that you're investing in, while fractional ownership is like a stock. You can pick and choose and curate your own portfolio of assets that you want to invest in. So this idea of selecting, picking and choosing is available in fractional ownership. In REIT, your money is in the hands of a mutual fund manager, or effectively the fund manager that you're investing in those basket of assets. So really, as an investor, it's your choice whether you want to pick and choose your stock or you want to invest in a REIT. There are pros and cons to both. The second is obviously the volatility. REITs are listed in the stock market, so they're much more correlated to the stock market. REITs goes up, stock market goes up, the REIT goes up, stock market goes down, the REIT goes down. So you're not really getting the benefit of diversification away from the stock market, which traditionally, when you want to invest in real estate, you would want to do, which is what you're getting in terms of fractional real estate. And the third is obviously in REITs, because it's a basket of assets and the way it's structured, the level of closeness to the asset, the ability to study each and every document, the ability to see the title report, the leave and license agreement into what you're investing, it's not possible in a REIT. It is possible in fractional ownership. So those are kind of the major differences between fractional ownership and REIT. In fact, Samir, would be good to get your views on how we've seen public REITs versus fractional ownership perform globally as well.
No, sure. So public REITs, the biggest problem, and especially I'll talk a bit about the US, with rates going up, REITs actually fell quite a bit. Some of the REITs fell almost 25, 30% as rates actually went up. Whereas some of the private REITs, so Blackstone has private REITs, where the NAV steadily kept actually going up. So that was definitely eye-opening, at least for me, of how volatile public REITs can be. I guess one of the things people ask is, what about liquidity? Because public, obviously, REITs, you can exit anytime. Private REITs, it takes a bit of time. In fact, Shiv and I have been talking about how to give more and more liquidity around private REITs, which we will start giving in probably a year's time. But other than that, I would say private REITs are much better because volatility is much less. Your mark-to-market losses are obviously not there, what you get in public REITs. And as Shiv, you pointed out, one is a mutual fund, whereas one is a stock which you actually choose to invest in. So I guess these are pretty much the differences I've seen, especially around the US markets.
Great. No, thanks, Samir. So I'll touch a little bit upon where we are with hBits, and then I'll open the panel up to questions. So just to touch upon where we are with hBits in our portfolio, given that we're growing. So currently we're at 150 crore AUM, looking to touch 1,000 crore AUM by in the next 12 months. So far, we're spread across 8 assets, have some great tenants in our portfolio, including Mane, ICICI Bank, SmartWorks. We work with trusted partners like Deloitte, JLL, Shardul Amachal Mangaldas as our legal partners. And what I want to concentrate on, though, it's not just talking about what we've done, but what I want to concentrate on is the kind of assets that we've selected and how they performed so far. So I'll touch upon a few examples. One is, one of the first few assets that we did, Sameer, in fact, is we've given our investors, we're one of the few fractional ownership players to actually give our investors an exit. So in fact, in the one asset that we have exited, we've given our investors an exit of 17.5% IRR. So it's a very, very lucrative exit for all the investors. In fact, it beat our target IRR for that asset class, for that specific asset. So a very attractive asset. The second is an asset I want to talk about is an asset that we picked up in Akriti Center Point, where ICICI Bank is the tenant. And when we listed the asset, we were so happy about the price that we picked up the asset at. This was in May 21 last year, and we picked it up at a per square feet rate of 11,661 rupees per square feet. We were very confident that it was a very good pricing. Obviously, we had to educate a lot of investors on why it's a good pricing. But in fact, right now, recently, I heard that in that building, maybe a few months ago, a transaction has been closed at 16,000 rupees per square feet. So, it's so important, the entry price at which you enter an asset, because once you enter an asset at a good price point, then you're very safe and very, very secure. So all of our portfolio is doing very, very well. And I owe it to our asset selection strategy. To touch a little bit on our asset selection strategy, Sameer, we basically, work with the top IPCs, your JLLs, Cushmans, Colliers, as well as a lot of local channel partners to source the assets for us. We also have great connect with a lot of the developers in the industry. So a lot of them bring the assets to us directly. So we have a wide variety of assets that we can pick and choose from. It's not like we have a few assets and then we're deciding which to pick. We have a large number of assets that come onto our table every day. And then it goes through a very robust and very stringent criteria before we even start negotiations with the seller of the asset. And we look at various different metrics. We look at the building quality. We look at the micro market or neighborhood that we're investing in. We look at the tenant in place in that building. We also look at the other tenants within that building. We look at the strength of the leave and license agreement between the tenant and the landlord. We ensure there's a strong lock-in. We ensure that there's a long notice period. We ensure there's a good security deposit. But there are a lot of other smaller clauses that are relevant that make it a strong agreement. And in fact, during COVID, we had 100% collection and rental, 0% delay. And I owe that to our tenant selection strategy. I owe that to the strength of the leave and license agreement. That's why we're very strong on the tenant and the leave and license agreement that's in place. Along with that, we do a very strong rental and capital value benchmarking. So we work with our data partners, CRE Matrix, to look at each and every leave and license agreement, each and every sale transaction that's happened in that building, as well as in that micro market, to make sure that the asset we picked up is at a lower rental and a lower capital value than the micro market average. Only once we've done all this, do we even start entering negotiations with the seller of the asset. And post negotiation, obviously, we do our technical due diligence, we do a commercial due diligence, we do a legal due diligence where we work with Shardul Amachal Mangaldas. So it's a very robust process to selecting an asset. So, while we've covered in this discussion why CRE is a good investment, it's not like you can invest in any commercial real estate and expect to make decent returns. You have to still be very particular about what asset you're investing in within commercial real estate. With that, Sameer, unless you have anything to add, we can open it up to any questions that there may be.
I think, Shiv, that's amazing. And I've been with the firm for 1.5 months. Very, very impressed by the way they deal around the purchase of assets and what we provide to our investors. No, thank you, Shiv, for that. So why don't we open it up for Q&A? I think we have 6 questions here. Okay.
I think some were just asking when the session is starting.
Yeah.
Sameer, do you want to take this one? If you have any comments on Chinese aggression on Indian economics.
Sure. So this is, I guess this is always pretty much on everyone's mind. And recently, as we saw Pelosi going to Taiwan, We saw that China was reasonably aggressive around what they were saying to the US people. Now, China, we've honestly always seen as being very aggressive. They use obviously a lot of words, but when it comes to action, it's always the action is there, but it's muted because they are also concerned around support from the US, and especially for countries like India, Taiwan. So my view is they will not be very aggressive, specifically for India, because they're also concerned about the losses which they would have, especially given our military might. That's one. Secondly, India's relationship both with US and Russia are extremely, extremely good. So I personally feel that it's not going to have too much impact on Indian economics. That's what I would say.
Great, thanks, Sameer. There are about a few questions, similar questions on, what is your asset pipeline when you're listing your next asset? I think a lot of our investors are waiting for us to list a new asset. There's a lot of interest in that. And yes, there has been a little bit of time lag in listing our new asset. And, I owe it to our asset selection strategy in that we're very, very particular, and especially when markets are volatile, which they have been. We don't want to jump into any risky asset. We don't want to take any risks. So only when we're sure will we list an asset. So while we have aggressive targets to grow, our priority is to only list the best assets on our platform. At the same time, we are negotiating for a few different assets, which should be listed on our platform very, very shortly. There's another question on the structure, LLP structure versus company structure. So yes, both are attractive structures in terms of LLP versus the company structure, where we currently have equity and debentures, and they're both workable. What we have seen though is that most investors would rather own shares and debentures in a private limited entity that owns the asset. Investors are much more comfortable having those physical shares as opposed to being a partner in an LLP, and that's the reason why we're working with the company structure. So there's another.
Shiv, there's another question around the planned investments in CRE projects in South India.
Yes, we are looking at South India as well. In fact, our plan is to be in the top 6 cities, out of which 3 are in the south: Bangalore, Hyderabad, Chennai. Within the next 12 months, we will have an asset, at least one asset in all these 3 cities.
Yeah. And so there's a question around the ROI we can get after investment in a fractional asset. So there are 2 components for the ROI. One is, of course, the rental income which you get, which is anything between 8 and 9%, plus the capital gains. And the fact that we make sure that the asset which we buy is actually below market price. So hoping that the appreciation which you get will be quite good. So my guess would be anything between 11 and 14% is the ROI you could get on investment in a fractional asset.
Sameer, there's another question which I'd like you to answer. How is Proptech changing the real estate sector in India?
So I actually think Proptech is amazing, and we've seen this in the US also. Earlier on, what used to happen is people, so only if I had a lot of money, I could actually invest in real estate, unless I had 10 crores or 15 crores where I could buy. Now with fractional ownership or Proptech coming through, it's doing 2 or 3 things. Firstly, one person does not need to go and actually see the property over the web or over the app. You can actually pretty much decide whether you like the property or not. That's one. So that's basically a lot of saving of time. All the agreements, everything are on the web page, are tech driven. So that's very, very good. I think over time, the analytics on how we decide on the property will also be on the web. The lease rental agreements are also on the web. So definitely tech is playing an extremely, extremely important part in analyzing data for you. Earlier on, this was never available, but now at a click of a button, that changes. So that's one. Secondly, over time, you'll see it's becoming more like a stock market, right? You can pretty much see on your app, or once we have the app ready, or on the web page, what your holdings look like. So suppose you have invested in 5 different properties, you can actually see the different properties there in your portfolio. That's second. Thirdly, I think the liquidity. I think you will get a lot more liquidity going forward. We have a plan to provide liquidity in 12 to 18 months, where effectively you could trade your property like a stock, and you could exit within 1 or 2 days. So that also, I think, is going to happen. And finally, I would say there's more transparency, right? The property market never used to be transparent before. You had no idea what transactions were happening. In this case, it's very, very transparent. The asset manager, in case of hBits, is very knowledgeable around the property. And definitely that knowledge effectively is being passed on to our investors.
Thanks, Samir. There are a couple of other questions which I'll club together. What is the USP apart from rental income, and how exactly the exit policy works? So, one is obviously the rental income. Other is the appreciation, which comes with owning the property as rental increases and as the property appreciates. Which, to answer the other question, how does the exit policy work? There are 2 different ways that investors can exit. One is they can list their share on the platform, reach out to, and then we'll assist the investor in exiting it to a future buyer, one of the other investors who are constantly on lookout for a share in the property. And second is in 4 to 6 months, in 4 to 6 years, we look to exit the full asset. So those are the 2 ways in which the exit works. There's another question on what is the minimum investment of fractional ownership, and is there any lock-in period and time period to exit? So minimum ticket size is 25 lakh. There's no lock-in period for the investor, but we recommend to stay for a longer period of time, at least 3 years, because it's a long-term investment. That's when you capture appreciation. And that's also when you have long-term capital gains as opposed to short-term capital gains. Samir, there's another question someone's asked on the recent article on AIFs. Yeah. I guess someone must have read that.
Sure. So our plans are basically we've started work on the AIF. We want to start a category 2 AIF which invests in real estate. This will help our fractional ownership platform. We plan to, in the first round, we plan to raise up to 500 crores. Our SEBI application for the AIF should probably go in a month and a half. We've already, like I said, we've already started work on it, and we'll start raising money in the AIF. In the AIF, the minimum size is much higher. It's 1 crore and above for individuals. And we will also be tapping a lot of institutional investors, both locally in India and from offshore. So people like Creative Venture Fund, GIC, some of the very smart investors in real estate, we'll also be talking to them to invest in our AIF. So I think that will probably happen in 4 to 5 months, because the SEBI approval itself takes anything between 3 and 4 months.
Great, thanks, Samir. Samir, I think we've already crossed the time that we had for the session, so I think we'll wrap it up over here. There are a lot of questions that are coming in, which we'll have our investments team answer all of them to you, so that no question is left unanswered. Thanks a lot, everyone. Thanks for that, Samir.
Thank you so much. Thank you so much.
Thank you, everyone.
Bye.
Bye.